Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. In the world of bonds, few firms are as powerful and enduring as PIMCO, and few investors are as storied as Bill Gross, whose impact on active fixed income trading and risk management has been substantial. The Bond King by Mary Childs is a compellingly researched and written book on these two subject matters. Through hours of direct conversation with Bill Gross, discussions with many of the significant players at PIMCO, and a careful recounting of some of the most consequential events in market history, Mary presents a story that began in the early 1970s, reaching a tumultuous unwind in 2014. Through our discussion, we learn of Mary's first interaction with Bill Gross, finding herself at Bloomberg as a reporter and on the wrong side of communication of a P&L number he took issue with. Motivated to bring the less well-understood world of fixed income to life, she set out to chronicle the founding of PIMCO and its tremendous growth under the leadership of Bill Gross. Along the way, we learn of clever arbitrage trades from the 1980s, we revisit the global financial crisis, and we get an inside look at the personalities that formed a culture both intense and deeply committed to research. I hope you enjoy this episode of the Alpha Exchange, my conversation with Mary Childs. My guest today on the Alpha Exchange is Mary Childs. She is the co-host for NPR's Planet Money podcast, also a journalist who has been a senior reporter at Barron's Magazine, Financial Times, Bloomberg News, and has produced a quite excellent and important book, The Bond King, on the storied history of PIMCO and Bill Gross. Mary, thanks for being a guest with us today.
Thank you so much for having me. It's an honor.
Well, I have read my fair share of books on finance, both theory and markets themselves, and read a lot about the financial crisis, and I really, really enjoyed your work. It was a truly deep dive, not just into PIMCO, but you bring so much to life throughout some of the tumultuous period during the GFC and some of the post-crisis aftermath. So we'll have a lot to talk about as you kind of tell us about how you came about this project and the experience of it. But let's get our conversation started with just a little bit more on your background. I'm definitely going to have a question on your honors thesis on media sting operations in the US and India. That's quite interesting.
Oh, that's awesome. You were the first person to land on that.
Tell us a little bit about yourself. It's a really interesting path that you've taken, but just give us a little bit of your background.
Sure, happy to. And thank you for your kind words about the book. It truly means the world. So I majored in business journalism in undergrad, which is a bit unusual, but I had an internship in political reporting and found it just so foreign to me. And I just couldn't understand, how scoops worked and how it felt like so much favor trading. And it just felt really kind of inaccessible and a little gross to me. No offense to political reporters, it's important work. But then when I kind of transitioned to business journalism and realized that I had numbers to check my sources and to be able to do some kind of, poking around on my own and figuring things out on my own. And I found that a lot more well-suited to my interests and a lot more fun. And so I took a bit of an interlude before starting at Bloomberg News as an intern in 2009, where I took a year after graduation to do a fellowship traveling the world and painting, which was really amazing. I'm so glad I got to do that. I was painting portraits and just getting to know different people and cultures, and it was sort of a fire hose of information. And then I landed in New York City at Bloomberg, and yet again, another fire hose of information. They have a really great internship program, so I got to rotate through different teams and see how money flows from one thing to another and how different asset classes act, and found that I really loved bonds. And I was kind of confused why no one talked about them more in the mainstream. I had watched CNBC, I had watched, financial television or just regular television, and it felt like we were always talking about the stock market. And I was like, I think, this other whole world might be more important. And I've since kind of realized that this is the institutional stance of Bloomberg, so to some extent I was just drinking my employer's Kool-Aid, which is great Kool-Aid, but chief among the influential people in this world was Bill Gross. And I remember reading these articles, that my colleagues would write when I was on the stocks team about Bill Gross, this guy I'd never heard of, was saying something that moved the market. And I was like, what that's not unusual. There are a couple people that can do that, but I just was struck by how little information in the mainstream there was about this guy, his firm. And that was the beginning of it. I covered bonds for many years at Bloomberg News and then kind of did alts and other things at the other places, but always kept this appreciation for credit markets. I just think it's the funnest place in financial markets and way more influential than it gets credit in the mainstream. So this book was sort of an attempt to bridge that gap a little bit, to make a little bit of an inroad in the popular culture, hopefully, that, here's a whole big world that people aren't telling you about nearly as much, in part because it's not as accessible to retail traders, sure, but it just matters. So yeah, that was it.
So one of the things someone like yourself is always challenged to do is find that next relevant area. As you said, could be bonds. And I'm looking at, and in fact, I had read your piece on SBF, a little bit in the news these days. So maybe we'll get a chance to circle back on that. You've posted an audio file just in terms of some of your investigative work there. Tell us about just the broad process of someone in your seat determining where to go next, where to look, how to have a kind of ear to the ground in terms of what's relevant, what's going to be important. What have you learned along the way just in terms of that process?
Oh, I love that question. The number one thing for me is sources, is talking to people in the market and talking to as many people as possible in and around the market. And just based on my kind of bias of what's interesting, that often does mean credit market people, private credit, like whatever, that world, I just find it to be so fun. And the kind of shenanigans that people get up to, absolutely fascinating and enormously consequential. And Bill Gross was obviously the kind of biggest and most obvious story to me. And I absolutely still believe that. And I'm so glad I did this book. But you're right, there's so many, and there are so many springing up every day. And I think the thing that I look for personally, there are a lot of these bold-faced names across our industry, but not all of those characters, if you will, are necessarily that reflective. I think Sam Bankman-Fried's actually an example of someone who thinks about what they're doing and how and why and where they sit in kind of the arc of history, yada, yada. And Bill Gross is a person like this too, where he did a lot of public reflection on who he was and what he was doing. And, he's a psych major at Duke. So that made him kind of unusually interesting. People have been suggesting what my next book should be. And I'm like, first, I got to take a break, but thank you. The people that often get put forward as, next interesting characters are a little two-dimensional. If there's some financial market swagger bully, like I'm just like, there's not a lot of depth to plumb there, at least not publicly. And Bill was sort of unusual in this openness and some degree of self-awareness and large degree of reflection. So to me, that's what makes somebody interesting and special and kind of a natural protagonist, is someone who can take that step back and see where they sit and will be honest about it, or, as honest as possible.
Well, there's so much in this book. There is a lot of bitterness. There's some kind of scandal in some ways, internal scandal. But there's a lot of market history, and your access to Bill Gross, just in terms of what he shared with you, is quite amazing. Now, you're coming at it as a reporter, so you're not trained as a PhD in finance or anything. And so you certainly learned along the way, but there's plenty of parts of this book that are pretty in-depth, just in terms of getting a lot of the jargon perfectly right, exploring some complex trades. What was that like for you, just in terms of, obviously having a background just via your role at Bloomberg, but also getting more into the esoterica, let's say, of some of the trades. And one of my favorites in here is the GDR trade that they pulled off in the 80s, right? This is
so good, right?
A really fascinating kind of pure mispricing that they found and found a way to capitalize on. But just tell us about the learning curve a little bit, just in terms of some of the more complex aspects of the trades and products they were dealing in.
Yeah, so it was a learning curve. That's absolutely right. Coming from Bloomberg and having covered bonds, I definitely knew, and had enthusiasm for the subject matter, but it was so much more in depth. That's the beauty of getting to write a book, is you get to really dig in ways that you don't have time to do as a beat reporter. And the fun thing about being a journalist, and the kind of really lucky thing, is that you're supposed to ask dumb questions. You're supposed to be like, wait, I'm sorry, what is this trade? What is a bond? And it doesn't matter how basic it is. You need to understand everything. So in this one, I had years of experience covering bonds. I kind of had a good feel for the jargon and a good feel for, more vanilla products. But getting to dig into something like the Ginnie Mae trade, that to me is where the fun is. And I think there's this stance in a lot of journalism and financial journalism to a degree where we feel like we have to sell it to people. Like, bear with me, or like, this is going to be worth it, I promise. And you don't have to do that. Like, the joy is in the mechanics. The joy is in the structuring, in the specificity. And I find that, I was reading this book that I've referenced a billion times at this point, but it's called American Bonds. And it's about how it's a sociology perspective on credit markets. And it says, the way we bound structured products reflects our values, reflects our morality, reflects who we want to be in and who we want to be out. And I find that so fascinating and powerful. And that's a way I hadn't thought about it, but it's absolutely true. Like, not only do these things matter, but they're fun. And that kind of engineering, once you get to the point where you know what people are saying and the words that they're using, this is the way we, bludgeon each other with specific little phrasing in the contracts that nobody else read, or forcing, physical delivery where everyone wasn't expecting that, or whatever the thing is. It's demonstrations of power. It's how we make our reputations. To me, it's the meat of it and the really fun part. I've kind of been enjoying the like Amazon reviews of my book, because half of the people that have complaints are like, oh, it's too juicy at the end. It's like TMZ, and I didn't want that. I wanted more about the trades. And the other half of people are like, the first half has too many trades. I really liked the end, like all the management drama. So I'm like, okay, if I take the average, I'm happy with these complaints. But it is like, to me, you need both. Like, these are both ways that we express power as humans, right? Like, we mess with each other in different ways. And sometimes that's forcing delivery on a trade. And other times that's nasty email or, showing up in a meeting. So it's the same thing. It's just a different delivery mechanism.
Well, take us back, let's say, to the early 80s, and maybe just a little bit more on this trade and the characters involved, because it's a much different PIMCO. It's a much smaller PIMCO. The bond market is smaller and much, much less sophisticated. So talk us through just the players. I know Bill Gross and Chris Dianalis, they flew to Chicago, to pull this caper off. It's just such a enjoyable read, just in terms of the planning and getting it done.
Oh yeah, it's so fun. I will say it was Dean Meiling and Pat Fisher who went to Chicago, but Bill and Chris were the architects in Newport Beach. Sorry, slight distinction. But yeah, it was this trade that, a lot of people just hadn't read the fine print of this brand new derivatives contract. They made some assumptions, and there were reasonable assumptions in the kind of interest rate environment that they'd been in. But PIMCO realized that when rates started to turn, it would change the kind of structure of the market, the liquidity of the market. So the contracts that they were working with, they were tied to Ginnie Mae bundles of mortgages. And when interest rates started to fall, the cheapest to deliver, because of negative convexity, those suddenly became finite. So I think people just hadn't realized that yet, hadn't updated their, mental assumptions about what's going to happen to these derivatives when interest rates start to fall. And PIMCO was like, okay, here we go, and managed to amass a big enough position that they could force delivery of these, cheapest to deliver Ginnie Mae's, and people just didn't have them. So there was they basically outsized the market, showed up and said, hand over your cheapest to deliver. And if people didn't have that cheapest to deliver because there was such a scarcity at that point, they were like, okay, here's the more expensive to deliver, I guess. Like, here you go. So that to me was the fun part. I mean, there's another kind of leg of the trade where it could convert into a perpetual. And there were apparently a couple of people still receiving coupons on those contracts, like very recently, which I love. But the idea is just other people hadn't read these contracts as closely. Derivatives were pretty new. This was the first stab at this type of contract. And it just was imperfect. There were too many different levers to it. There were too many different ways. People were still trying to figure out how to write these contracts in such a way to get a market going. So you needed to make them attractive enough for users. And I guess it just made this one a little bit too attractive by accident, or maybe just didn't think through the kind of ripple effects of how is this product going to act when interest rates change direction. So that was the insight there. And they weren't alone. The idea was also, I think someone at Lehman was doing it, and it became this legend on Wall Street that, people got carried out. The traders in Chicago were literally waving their, white hankies in the air in surrender. It was truly a tour de force. And among the people who were in this product area and a little bit outside, they were like, okay, beware of PIMCO. Like, they know what they're doing. They're doing more work on these contracts than you are. If they're amassing something in size, maybe you should run.
Right.
Maybe you've missed something here.
Well, there's a component to that trade that I think reminds me a little bit of the GME debacle
Mhm.
back in January of
Absolutely.
2021, which is just a market shortfall. There's a shortage. And anytime there's a shortage, the price could become extremely high and unfavorable to the person that needs to cover the short. So that's really interesting. One of the other things you do here, which I really enjoyed, is you go back to the founding of PIMCO and Pacific Mutual. And I'd love for you just to share this whole pitch that Bill Gross made. Basically, this whole idea that you can actually trade bonds, that the value will go up and down. You don't just need to tuck them into the vault. And there's a real earnestness to the building of the firm at that such an early time frame, where they were kind of in uncharted waters, trying something new. But just tell us a little bit about that, because that's really important history for the bond market itself.
Absolutely. And it is a little mind-boggling to look back, decades later and see that this just didn't exist back then. Like it's just kind of a leap, right? And they were, in that way, that I guess that makes them like visionaries, because they saw this world in which bonds could be traded and didn't need to just be these stagnant things, in your, as you say, in the vault that you sent in, your little coupon for your interest payment. And that was that. So yeah, he worked for this insurer, and they basically had no interest in, dynamic bond trading, in active bond trading, because they had this very nice system of stacking up their liabilities against their assets, against, what kind of money do I need coming in? What kind of money do we need going out? And bonds provided a very reliable stream of income that they could match against their outgoing liabilities, and everything was great. And Bill Gross is like, well, what if I traded them? Which is, scary. And, people say this, and I have this in the book, but it was really kind of a leap of faith on the part of his bosses to say, all right, here's $5 million in a little shell company. See what you can do. See how this goes. Go out there and trade some bonds. There were very few counterparties at this time. But the reason that they were amenable, that they did agree to this, not only because they, liked Bill and thought that he could do well, inflation was really high. So if you have these bonds sitting in the vault, they're just losing value by the day, right? And there could be a newer, better bond out there that's paying a higher interest rate that you should be buying. So if you're able to find a buyer for that bond, yeah, maybe you should take your money and put it elsewhere. So the argument was kind of bolstered by the macroeconomic conditions. And I do think that Bill grabbed onto that and saw this opportunity and was like, all right, I'm gonna try this. So that was the dawn of PIMCO, well before there was really a market to be made. And one of the things that people say about Bill is he didn't invent the market. Obviously it's impossible for one person to invent a market because you have to trade with someone. But there is this guy that I talked to who was extremely fun. I cannot find any other reference to him really anywhere. His name is Howard Rakoff, and he's one of Bill's dear friends. And he's kind of the patient zero of active bond trading. So yeah, it wasn't actually Bill Gross. Bill was kind of radicalized by Howard Rakoff. And Howard came to him and said, I'm obsessed with trading bonds. You got to try this. And he loves Bill's enthusiasm for it. But it really, he was the one going around the country getting people on board and trying to find people to trade with. So that was really fun to discover as well.
Well, they start making progress. They land AT&T in 1977, I think, and then RJR the next year. So they're starting to get more credibility. They hit big on this Ginnie Mae trade, and I think you said 83. So they're getting the kind of credibility from an expertise standpoint. What were some events after that were consequential, just in terms of the earlier days of the firm from a growth standpoint? Anything stand out maybe in the late 80s or 90s?
Well, there were so many things that I didn't end up finding a place for in my book. I had a very plodding textbook history of PIMCO that was like an earlier draft. And my editor was like, oh, Mary, no, no, this is not what we want. Because it was just like in 1986, they negotiated again with management about the payment structure and the profit structure and how they could be compensated. It was a little bit too in the weeds. I thought it was very interesting. But there are interesting kind of business school case studies to be made about the compensation structure and how they spun out gradually over the course of the 80s into their own kind of entity, because they had this relationship with, their parent company and tried to sit, it was a bit of a mismatch, right? Because if you're this kind of flashy up and coming fund manager in a world which hadn't been very flashy, the buy side wasn't really the place to be at the time. But Bill's driving around in a fancy car with the license plate Bonds 1, and parking right next to the president and being like, or parking right next to the CEO and just kind of swaggering around. And the rest of the people at the insurance company are like, who is this guy? Like, what is this? And they were told, you are welcome to act like that the minute you start bringing in money like that. Feel free. So there was a bit of a culture clash. And I think Bill kind of recalibrated over the years. But 94, they had like a reverse merger. They went international. There were a lot of different, and then in the late 90s, they tried to start up this equities business, which they basically started and shut down relatively quickly because it got caught up a couple years later in the mutual fund timing scandal. Big hobby horse for Elliot Spitzer. So there was so much complexity and nuance there. I wrote an entire chapter about the equity thing, and the chapter just is on the cutting room floor. So I'm happy to read it to you one day, but it didn't make the cut.
Well, you mentioned your first kind of version, which was a little bit too textbook oriented. So this was obviously a very challenging project for you. I mean, you can't produce something like this without, I'm sure, a lot of good days, but also a lot of more challenging days. What were some of the really challenging aspects, just from a gathering information standpoint? What were some of the roadblocks that you ran into?
So many. I mean, kind of from a broad standpoint, these are obviously people that are used to having control over their own narrative, right? And many of them were really not pleased that I was writing this book. The events of 2014 were deleterious to their net worth because their, shadow equity in PIMCO got dinged, and they wanted that to all go away. They wanted the bad news and the bad headlines to go away, and they really didn't want me to, write a book and publicize a book about all of the drama. So that was probably the biggest obstacle. I think probably the biggest thing was one of the central characters wouldn't talk to me. Muhammad Al-Arian kind of stonewalled me for 7 years and refused to speak with me for the book, which is obviously his right, but he's a very central character. So I had to kind of go around and talk to all of his friends and anyone in the whole universe who had ever worked with him who could paint the picture for me of, okay, he was feeling this way. Okay, this is what he was annoyed about. This is what he would be complaining about. And this is what he liked at the time, and try to synthetically recreate what his experience was. And then in a little turn of events, I got, a note from a representative of his in December 2021. So we are like days, in the double digits of days before my book comes out. And they're like, hi, Muhammad Al-Arian would like to speak. And eventually we get a note or a letter from his lawyer. They had obtained a pre-publication copy of the manuscript, which is not something that anyone in the process would do, right? Like, the publishing industry is very accustomed to sensitive material, right? So it's just like, how did this happen? How did they get a copy of this? And they had notes. So they had on page this and such, we object to this characterization. And some of them, were kind of funny. Like there was one about the timing of ordering a cake. And some of them were very helpful. And there's one instance where, so for example, I suspected, just based on talking to people, that the treatment of Muhammad Al-Arian's desk after he announced he was leaving was kind of a sore spot. And that, I got to reflect in the manuscript because I got these notes from his lawyer. So, I wish he had talked to me. I wish I could have gotten more of an inside look at his life and his mental state and what he thought. But luckily for me, he had talked publicly about a lot of this, and I could do, the regular reporting thing to triangulate and substantiate. And then I got the absolute delight and stress of a lawyer letter, and I got to add all those notes in. So absolutely not how I would have wanted any of that to go, but the book is obviously better for having his perspective in it. I was a little, gratified to see so much of my reporting corroborated, and of course delighted to have him participate, but that was stressful.
Yeah, his contribution to the book was absent, and he doesn't come across incredibly well. I find him to be a superior thinker on markets. I mean, I have to just say, he was so right on COVID, early days. I mean, February of 2020, the warnings that he was giving to people were, I thought, invaluable. And I also think he's gotten this Fed cycle incredibly well. But, he's working alongside Bill Gross. So these two guys are extremely talented and extremely passionate about what they do. Was there any shared, just in terms of characteristics, where, hey, this might have worked had things been a little bit differently? What were some of the things that might have worked between the two of them?
Oh, what a great question. I mean, they were both really excited about the prospect of their working relationship, I think. They do share a lot of they're both very mediagenic, albeit in different ways. They're both great at breaking down complicated, like you're saying, great at breaking down these kind of complicated financial ideas, great at seeing these seismic shifts, great at talking about them to a lay audience or a not lay audience. So I think they do share that kind of brand or face element. I think people, maybe they didn't account for the fact that like Bill didn't really like it when other people had the spotlight is what I was told from a lot of different sources. So I think maybe that was baked in, that difficulty, and the handoff would have been difficult no matter what. But I do think they share a lot of similarities. They're both, intense and hardworking. I think they manifest their intensities very differently. And that made them kind of oil and water, made them not able to speak the same language of what they were doing. Muhammad Al-Arian would be in the office super early, and I think both of them valued FaceTime, but they didn't really overlap that much. And, Bill would kick off to go golfing or go to his exercise classes, which I think he thinks of as accretive to, his ability to see clearly and keep his head clear. But they also, Bill's all about granularity and trades and the Taylor rule and Phillips curve and all of this. And while Muhammad Al-Arian absolutely talks about that stuff too, I think he's much more of a macro thinker and much more of a kind of a macroeconomist, not a trader. And, he has overseen trading and has been a trader, but it's just not the same kind of position, the same stance. And they just have different goals in that way. So those conversations were a little bit doomed, I think.
Well, Bill Gross is obviously the central character of the book. And so I'd love to get a better understanding of just your interactions with him, getting to know him, what you took away that you didn't expect to, what you might have thought in the beginning that didn't turn out to be right. But I want to first, before we do that, I want to read just a quote from you, which I thought was just summarizes very well his style. He's writing that investment outlook since I think you said 1978. Boy, that's a long time. Obviously, as you say, a kind of a force of personality type of person. And you write here that part of his style was this idea that he could grind his view into everyone's consciousness. And this idea that by kind of speaking his book, by telling everyone what he thought with such consistency and in so much depth, that he could sway opinion. He could sway the feeling or the way in which things were priced. And at no point was that more prominent, and I'd love to talk more about this, than during the financial crisis. So tell us first, just in terms of the process of getting to know him and things you took away from that process.
Yeah. One thing about Bill Gross that I think almost any journalist will tell you is that he is to some degree just an open book. I arrived more or less on the beat in the aftermath of Muhammad Al-Arian's departure. So I was kind of, the new kid in school. I think he already had relationships with all of the other journalists, and he doesn't really think about cultivating relationships with journalists in the same way that a lot of other people do. He appreciates a kind of, appreciation for credit markets. I think that was helpful for me, that I knew what he was talking about when he described trades or what he was doing. But because I arrived fresh, I think I just didn't have any priors. I didn't have any axe to grind. As people always think that journalists have axe to grind. We really don't. We just want to write down what happened. But maybe just speaking for myself there. But, I'm like the new kid in school. Everyone's trying to tell me what happened so that their view is the one that they hope that I'll carry forward. And I think that, Bill was talking to me and, telling me about different trades that he was working on or putting on at the time. And I think I didn't understand as well at the time kind of my own role in the world. As a journalist, I've always been a little bit cavalier about talking to important people. I don't treat them as gods. It just never really occurred to me to be oh, thank you so much, sir. I don't really have that tone. And so in the beginning of talking to Bill, I think he's so accessible. And to some extent, I think that all of the things that he told me, he might have told anyone, right? I just was kind of the person who was there. And there are ways to be the person that is there. You demonstrate that you are receptive or, not biased or any number of things, or, can talk about the market in an interesting way. But it is to some, he's actually just a reflective and open person. I was a little nervous, it didn't occur to me until I was writing the chapter that involves Bill Gross's divorce. I'm reading, the documents that came out in that were pretty not great. It was a really tumultuous time, and I don't think Bill Gross would condone the actions that he took at the time. And I'm reading this and I'm oh, it really didn't occur to me that he might do that to me. He might do things that are, to make my life uncomfortable, or if he's unhappy with the book in some way, he could be, petty about it if he wanted. And I was oh God, wait, why did I not think of this before? That seems bad. I know about that, but I think of myself as such an outsider and being this kind of, I don't know, in a vacuum, in a different orbit, and just writing down the truth. So that was a little jarring, but he's honestly been nothing but respectful. He's been competitive, which is, on brand. But he published his own memoir 2 weeks before my book came out and was out there tweeting about it and Instagramming about it. He started an Instagram account to promote it. So honestly, I feel like that to me demonstrates like he's just a competitive guy. He really needs somebody to compete with. And I was happy to be that person. It just was an interesting moment to be kind of in the seat that a lot of my sources had been in an abstract way. They told me about, Bill acts this way, Bill acts that way. But I finally got to experience it when my book came out that, here I am on the field with Bill in sort of a way that I didn't expect. So that was really interesting.
There's a lot of contradictions, and I guess maybe we all have some version of contradiction. He's incredibly competitive. He seems challenging to work with. He's incredibly charitable in terms of giving. So there's a huge force for good there. One of the areas that you probably spend the most time on just in terms of markets is the financial crisis. And it's this telling of PIMCO preparing itself for what it sees. And listen, this was as chaotic a time period for anyone in the markets as we've ever experienced, really, for the better part of 2 years. What did you learn from that part of your research and investigation, just in terms of PIMCO seeing what some others saw, but obviously being there early, so that's never easy. I think you actually do use the old quote, to be too early is to be wrong. And then just navigating through that chaos. What did you learn from that part of your research?
Yeah, I think it is true that so many people saw this coming. And the thing that I've learned, I didn't really think about the degree of like how people structured their trades around it, right? We're all impressed with the Michael Burrys of the world, the John Paulsons of the world. But there's an argument to be made that the risk that PIMCO took was structured better because it was safer, because they just pulled back. Yeah, they lost money going in. So like they didn't have the 2006 or 7 returns that they'd hoped, or returns that they really were proud of, especially in 2007. And I think that there's an argument to be made both ways. But in my view, what I learned from looking at this really closely is that because they pulled back, they were able to step in when everyone was panicking and selling stuff. And they were able to buy things up at a discount because they had the cash sitting there because they hadn't lost their money and they hadn't, they weren't the ones in a panic trying to sell. And that, especially I think in Iveson's fund, you see that over the course of like years then as they offload those securities and take profits, as you will. And that I think is, if I were like an investor, if I were a client of John Paulson and of PIMCO, that kind of looks better, where it's not this one, swing for the fences, kind of high risk, high reward trade that like if he had gotten the timing wrong, if he had been 5 minutes off, he wouldn't have made his money. There's this really great article in the Wall Street Journal from the time that was like this guy got in a motorcycle accident, like just a guy got in a motorcycle accident. And because of his medical bills, he wasn't able to make his mortgage payments. And because he wasn't able to make his mortgage payments, he was the last person in that, pool of mortgages that caused John Paulson to make his $1 billion. So it's like, if there wasn't a motorcycle accident, that trade wouldn't have worked. And that's staggering to me. So I guess it's the idea of informed risk and of structuring it, more carefully. It's just kind of making sure that the risk that you're taking isn't subject to the winds of chance and timing and all that. So that was fun to think about.
One of the things that really just jumps off the page throughout the book is, as we've been saying, the competitiveness, this burning desire to succeed. And I'd also say a desire, I don't want to say it's to be noticed, but to be credited with it and really struggling with mistakes. And so in March of 2011, he takes the entire total return fund out of Treasury securities. And, this was the debt ceiling year. And so ironically, the U.S. is on the verge of a technical default. And what happens, of course, the bond market rallies ferociously.
Right.
So that was a very difficult period for him. What was engaging, just in terms of the thought process during those difficult times? Forget the internal tumult, but just the market times when his market call was wrong and they underperformed, and just dealing with that disappointment. What did you learn in terms of, speaking to him about that?
That one is a weird one because it does kind of deviate from all of the things that he says about risk taking. And this is the moment that a lot of people point to as, this was when his credibility was undermined internally. This was like a dent in his armor and externally. He had to do this public apology for having taken the exact wrong side of this trade. And I think that, there's a lot of questions about the kind of risk management approach there. This wasn't one that we really lingered on talking. I feel like I didn't get anything more from him than, frankly, people got at the time. Because again, he does a lot of this publicly. He does a lot of the kind of mea culpa. Literally, the name of his investment outlook that in which he apologized was mea culpa. But it is a weird moment because the things that had worked so well for so long, he just suddenly throws them out the window and says, "Okay, I'm going entirely short treasuries." And I don't know if it's like hubris, if he's high on his own supply or whatever the sayings are. Like if he's thinking after the financial crisis, they were the stars. They were of the mutual fund world. Money was pouring in. Assets under management doubled. The firm's size doubled. So it's possible that he just felt, I don't know, really smart and got over his skis and made this big pronouncement and strayed from his risk management and or more consistent and less like, I don't know, cool guy on CNBC making a call strategies. I mean, people within PIMCO would say, no, this is Bill. Bill always makes these big calls. It's just that you don't see them at quite this scale and this publicly. And I think that's, of course, true. Like this was just it's just the scale and the publicity were next level. So it's a really weird moment.
Who were some of the kind of characters in the subplot that you really enjoyed learning about? Oh,
PIMCO is just full of these characters. I felt like it was sort of a rich tableau to the point where my editor was like, why do you have 35 characters? And even after culling so many of them, I'm just devastated that I wasn't able to include more people. And like some people reading it are like, I'm having a hard time keeping track. Who's Mark Kiesel again? And I'm like, who's Mark Kiesel? So I feel like Mark's a great one.
He's a close personal friend of mine.
Oh, amazing. I picked the perfect one. See, he didn't get enough airtime. That's what I'm saying.
The famous piece, For Rent.
Yes, For Rent.
For Sale.
Exactly, For Sale. It was so good and very prescient. And yeah, I think Paul McCulley obviously is such a good one. I feel like he's just so lucid and like normal. I'm from Virginia, so his accent is familiar to me. He just like speaks a language that I understand. But I think everyone does. I think everyone speaks his language. So he's just so accessible and smart. Scott Simon is another one that I think is like very delightful. He is kind of one of the few people within the entire book who has this devil may care attitude because he literally doesn't care. He's just kind of impish and, doing his own thing. And I find that sort of refreshing and a fun counterweight. Yeah, it's pretty full of characters. And then everybody's personality gets like really strong and pronounced at the end, when we're in the final moments and it's very stressful. I think everybody acts how their personalities just become super acute.
Well, you really brought a lot to life there. You obviously covered, a difficult time for a firm that remains incredibly successful. It's a storied firm led by a storied investor. So there's some challenges there, but you bring to life so much in terms of market history. It's really well written. It's a very enjoyable read. So I congratulate you for putting all the time and effort into it. I'm sure it was a beast of a project, but I'm sure you're glad it's done.
I sure am.
It's good to have you.
No, thank you. I so appreciate that. It means a lot coming from you.
Appreciate you being a guest on our podcast. And the book, again, is called The Bond King by Mary Childs. So thanks again, Mary.
Thank you. I appreciate it.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback. As we aim to utilize these conversations to contribute to the investment community's understanding of risk, your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.